Financial Accounting, Chapter 6, Inventories, Part 1 of 3. Let's do a quick review. Chapters 1 through 4 had to do with financial statements, understanding the balance sheet, income statement, and statement of retained earnings. Understanding that transactions are recorded in journals and that these journals are organized by a set of rules called debits and credits around the equation that's known as the accounting equation or the balance sheet equation. We found that from these journals, the numbers are transferred or posted to T accounts or in a computerized system to a ledger. From the ledger, a trial balance is prepared, and from this trial balance, we find that we can prepare financial statements. We found that we close every time period that we're ready to prepare a new set of financial statements, and we start the cycle again. So here we are with Chapter 6 on inventories that follows Chapter 5, where we introduced the retail store, retail or merchandising being the same thing. In Chapter 5, we talked about perpetual versus periodic systems. We talked about how to record cost of goods sold and what those transactions mean, gross profit and gross margin. So if none of this is coming to mind quickly, take a minute to go back and review the 3 PowerPoint narrations in Chapter 5. It might take you about 45 minutes, but it's important to understand Chapter 5 before we go into Chapter 6. So let's expand a little bit. In Chapter 6, we're going to be talking about inventory controls and the cost flow assumptions. Part 2, we're going to get into some details about FIFO, LIFO, weighted average under a periodic inventory system. And then we're going to get into some final wrap-ups about this complicated area of inventory. So first, controls. Control means just that, taking charge, taking control of our inventory to make sure it's not damaged, it's not stolen, to make sure it's accounted for properly, to make sure it's reported properly in the financial statements. As a reminder, you need to know what type of account inventory is. What financial statement does it go on? What type is it? And if you haven't thought so already, you should be thinking asset, a current asset, increased by a debit, decreased by a credit, recorded at the cost of the inventory. So when we control or safeguard our inventory, they're called inventory controls. We find that these documents are used, that we have specific documents that we use to control our inventory. We have POs, some of you are familiar with POs, we have receiving reports, and we have vendors' invoices. And all of these are documents internal to an accounting system to make sure that there's a list of checks and balances. So for example, if someone's in the warehouse and inventory has been ordered to sell in a retailer store, then a receiving report is going to be received that should be matched with a purchase order in the purchasing department, and the accounting department should be getting the vendor's invoice, and all 3 of these should match. So that's one of the important controls that we have in accounting, to make sure that we ordered the inventory at a specific price, that we get what we ordered. We want to make sure that it's arrived properly, that no one's stealing it, that they didn't send too much or too little, that the accountant pays for what was actually ordered, and all of these need to be coordinated. So safeguarding inventory is an important part. Why? Well, gee, let's go back to Walmart. They have over $30 billion worth of inventory at the end of their year, January 31st. That's a lot of inventory to account for. So these controls are extremely important. The purchase order authorizes the purchase of inventory. The receiving report comes from the warehouse that shows that that has been received, and all of this is compared to the invoice before it's recorded in the accounting records. And therefore, we're sure that we've safeguarded our inventory and that our accounting records show the correct amount. Finally, other controls. And this, by the way, is considered to be an internal control. If you ever take an auditing class, one of the big pieces of auditing is ensuring that the internal controls are set up. That's controls internal to the company. Employees who haven't had a business course, who haven't had an accounting or an auditing course, often get really frustrated. Why do I have to do this paperwork? I don't understand all of these crazy rules. Well, the purpose is that theft, embezzlement, misappropriation of assets accounts for billions of dollars a year. And inventory is a big piece of it because it's physical and easy to steal. And so these are some of our safeguards. Making sure that you have inventory restricted only to authorized employees, that the expensive inventory is locked up, that there's security tags and monitors. And this last one I've got in here is one of my favorites, separation of duties. So the individual in the warehouse recording that they have received some inventory to be able to put out on the store shelves has no idea how much inventory was ordered. That comes from the accounting department. And that separation of duties, as you see in the picture, separate custody from record keeping, from reconciliation, from authorization. This separation from duties is one of the most important internal controls that we have when we're dealing with inventory. Just to add, this is also an important control when you're dealing with cash as well. You separate the accounting from the physical control of any tangible physical assets. Okay, let's talk about reporting inventory. A physical count of inventory is required whether you use the perpetual or the periodic method. Okay, so I know as a student you're going, wow, she thinks I remember all of these things. And I understand how much there is to remember, but I'm going to kick in a quick reminder. The perpetual accounting method for inventory says that you keep track of everything that's sold, whereas a periodic accounting method says you don't know what's sold until you count what's left over. We talked about that with your wallet. You don't know how much money you've spent unless you keep track of it like on a piece of paper. I started with 100, I spent 10, I spent 20, versus a periodic method that says I started with 100, wow, I've got $5 left, I must have spent 95. So for the business world, when you're talking about inventory, every business should take a physical count of inventory at the end of the year or near the end of the year to make sure their financial statements are accurate, regardless of whether they use perpetual or periodic. And I know everyone has seen inventory guns. You've been into a store and you've seen they're actually they're actually subcontractors that come in and take inventory professionally for companies. So it's important to know that that's a big control of inventory. Goods flow versus cost flow. I don't know that the textbook stresses this as much as I do as an instructor for over 20 years, but it's an important set of concepts that students get confused. So goods flow talks about how does a company actually sell their merchandise. So for example, a grocery store is generally going to sell their old bananas or their older milk or their old meat before they sell the fresh meat that just came in the back door. If they don't, they'll have a whole lot of spoilage and a whole lot of waste. So generally goods flow out of a store. The merchandise in the store is sold. The oldest merchandise they try to get rid of first, even if they have to put it on sale. Now cost flow is different. Cost flow is an accounting function. Let me say that again. Put that in big bold letters on your notes. Cost flow is an accounting assumption, and it's what cost did we pay for the merchandise or the goods that we're selling. And the reason it's in there is because cost is not always the same. Let's give the easiest example in the world. If you go buy a gallon of gas today, and that gallon of gas costs $2.25 a gallon, underneath the gas tank where you purchased your gas is a huge giant container of gasoline. Not really good with the terminology, but there's thousands of gallons of gas in there to be sold. And the person that owns the gasoline store, the gas station, paid a different price probably for a lot of that, because you know how gas prices can change from day to day, from week to week. So cost flow says, how do we assume the costs flow in the merchandise that we're selling, whether it's gas or bananas or meat or green beans or whatever, versus goods flow is how are they actually physically moving. So most students get them confused. From now on, we're going to be talking only about cost flow. Management chooses, first of all, perpetual versus periodic. We've talked about that. Perpetual is the one with the barcodes. Periodic is the one that requires a count to know what you sold. But management also has to pick a costing method. LIFO, FIFO, weighted average cost, and specific ID. Yes, each company picks one of the four, or they can mix and match. If you were to pull up the annual report, for those of you going into accounting, this is going to be your life. Google Walmart Annual Report 2017, and when you pull that PDF file up, do a Control F to search for inventory, or maybe look for the word LIFO, because Walmart uses, I think, all three, LIFO, FIFO, and weighted average. Specific ID is not used as much, but this is the focus of the chapter that we're doing right now, and it is these costing methods. These are cost flows. So cost flow assumptions. First, if you look at this chart, notice specific ID is missing, and that's because it's not used very frequently. It's really hard to know exactly which item you sold. Specific ID assumes that you know exactly that I sold this car that cost this money. So car dealerships might use specific ID. Most stores will use one of these cost flow assumptions. Cost flow is in the order in which the costs were incurred under FIFO. It's the opposite under LIFO, and it's averaged under weighted average. So I don't know if these pictures, illustrations help you any, but basically FIFO says, I'm assuming that the cost of the first items of inventory that I bought is the cost of my goods sold. LIFO says, I'm assuming that the cost of the last inventory that I bought is the cost of my goods sold. Weighted average says, the heck with this, let's not track, let's just take an average. And we're going to be doing some examples of all three of these. Okay, so here's a key concept to help students. This again is something else that's not in your textbook, something that I have found that helps students as we go through this, and it's an algebraic equation. It says that if you take your ending inventory and add your cost of goods sold, that will tell you what you have available for sale. So it's very logical. A store has $100,000 worth of inventory that they've bought during the year. This store has either sold it or it's left on the shelves. Very simple. So the cost of goods available for sale represents the $100,000. If the ending inventory is $20,000, then the cost of goods sold must be $80,000. Let's try that again and think about it. The cost of the goods that the company has to sell are either left over in ending inventory or they're sold. Let me try one more stab with the wallet example. If you had $100 to spend, you either spend it or you have it left over. So if you spent $95, then you have $5 left over in your ending inventory in your wallet. Pretty simple, isn't it? Let's kind of throw this formula around. Cost of goods available for sale is equal to ending inventory plus cost of goods sold. These are acronyms. Let's look at it another way. Cost of goods sold is equal to everything available minus your ending inventory. Back to the $100,000. If I want to know how much I sold, and I have $100,000 available, but only $20,000 worth of inventory left over, I must have sold $80,000. Alternately, I can say that if I have $100,000 to sell and I sold $80,000, then I should have $20,000 left over. Do you see how this works algebraically? If you're sitting there going, Professor Bolt, this is nuts. Why are you giving me this really stupid formula? You'll find out why as we get into calculating LIFO, FIFO, and weighted average. So here's an example. Pretend that these are 3 identical units, and every single time we bought it, the price went up. Started out that we had to pay 9 to buy it, then the next one we bought 13, the next one 14. So the average cost is 12. We have a total of $36 worth to sell, but it depends. Are we going to use average, specific ID, FIFO, or LIFO? So let's see. If we were to say that we sold the $9 one, our gross profit is 11, our ending inventory is 27. If we were to say that we sold the $13 one, our gross profit is 7, our ending inventory is 23. If we were to say that we sold the $14 one, our gross profit is 6 and our ending inventory is 22. It's kind of crazy, isn't it? Notice our goods available are always $36. That is ending inventory plus cost of goods sold. 26 plus 9, 23 plus 13, 22 plus 14. It's always equal to 36. So it depends on the cost flow assumption. What cost do we attach to the item that we sold? Alternately, what cost do we attach to the items that are used in ending inventory? So let me pause again. This is all GAAP, generally accepted accounting principles. GAAP requires that a company choose one of these methods, that company stays consistent and sticks with this method, and that company must let its users of the financial statements know which one of these measures that they use. They're called disclosures or footnotes. Let's pause another minute and look. Under this assumption, $11 gross profit. Here, 7. Here, 6. So the cost flow assumption results in a different gross profit for every single one. So this is one of those slides I hate to see and cringe, and I almost deleted it and rewrote it, but I felt it might be helpful. It is straight from the book. But under specific ID, the assumption is made that you can specifically identify what's left over and what you sold. So a car dealership would know exactly the car they sold and what's left over. FIFO says, let's take the cost of the first items that we have in inventory, and we'll assume that that's our cost of goods sold. LIFO says, let's take the cost of the last items, and let's assume that that cost is the cost of the goods that we sold. And that would mean that ending inventory is made up of the first purchases. Finally, weighted average is also called average cost flow. That said, let's just take an average. The heck with all of these complications. We'll just take a weighted average. And it has to be weighted by the quantities purchased to give us the best numbers. Now, in case you're thinking, I will never do this in my life, this is crazy, I'm not going to work for a retailer. If you ever anticipate owning stocks or investing in the stock market, whether it's through mutual funds or pure stocks, an individual stock, you have to select FIFO, LIFO, average, or specific ID. Tax law. Okay, so let's look at these inventory costing methods. If this is our scenario, take a look under FIFO, what the ending inventory would be, what your gross profit would be. Under LIFO, what your ending inventory would be. It would be composed of the 9 and the 13, plus your cost of goods sold. And under weighted average, how we have done an average calculation, adding up 9 plus 13 plus 14, and dividing by 3 to get an average cost of 12. Don't brush through this too quickly because this one's difficult. Let me go back one more time and say this because we're going to be going through some more complex problems in part 2 of this chapter. FIFO says my cost of goods sold, what's gone out the door, that's what the FO, first out, what I have sold is the cost of the first items. And the first item that I bought was the one that I paid $9 for on May the 10th. LIFO says, I'm going to assume that the very last items that I bought are my cost of goods sold. And so that places the $14 as the cost of goods sold. And again, weighted average, as we said, takes an average. Missing here, of course, is specific ID, and that would be an example of being able to specifically identify which unit you sold. Okay, so this concludes part 1 of 3. Hope it's been helpful. Be prepared for part 2 of 3 by hopefully memorizing these 4 methods, understanding them a little more closely, because we're going to start putting them into practice.